Aren't you glad you signed on? You thought you were talking about legacy, and we're talking about Broadway shows. So if you're just signing on, you are signing on to the right webinar. We're just digressing. But I'm telling everybody the great things about McAllen Society. I might as well start off. If you don't know me, my name is Susan Damiani, and I'm the director of gift planning, but also the director of McAllen Society. And that's what I was talking about. To become a part of our legacy society is to be part of a great community of people, some of which are on this call, some of our members, and you get to participate in a lot of different events and activities, and we travel together. And so it's really great. So if you are, especially after this webinar, we hope you do think about your legacy. And if you do want to leave a legacy, we hope you leave it at St. John's University. So it's the start of the new year, right? It's 2026. And what do we all think about? New Year's resolutions. And I know for myself, even here in the Office of Gift Planning, how we're going to plan out the year, how we're going to plan out our lives. There might be some life events that are popping up this year or popped up last year that you say, okay, I really need to take a serious look at my finances and at my estate planning if I've done anything or I need to revisit it. I'm glad you signed on to this webinar because our Power Hour lunches are to power you up for an hour and to provide hopefully really good practical information that you could walk away and take care of things and put your life in order and your personal matters in order. So this webinar is starting the year off with your legacy in mind. And we have two wonderful alumni of St. John's who you may know by now if you've been signing on to these power lunches or you've attended my Meet the Experts next month. I'll be here 22 years, and I've been doing Meet the Experts literally for 22 years. So Donna and Phyllis Ann have both been, frequent speakers, and I appreciate all their time. I know they're busy attorneys and successful ones, and so it's really nice that you're able to carve out time for us. Let me just we do share the bios, but I'll just give you a couple of sentences so you know that you are in good hands when we're talking about legacy and estate planning today. We have Donna Fiore. She's an elder law attorney with an office located in Astoria. She received her law degree from St. John's School of Law and her bachelor's degree magna cum laude from Bernard and Baruch College. And Donna was the co-chair of the Elder Law Committee of the Queens County Bar Association from 2012 to 2019. And she is the past president. I could take up the whole webinar of all the clubs, Kiwanis Club, Catholic Lawyers Guilds. It goes on and on and on. So thank you, Donna, for coming and helping us out today. And then we have Phyllis Ann Polizzi Kalenka, and she is a partner at Spellman Gibbons Polizzi. How do you say his name? Troncal. And Tranta Costa. With offices in Garden City, New York. Her practice concentrates primarily in the areas of trust and estate planning and administration, as well as residential real estate and nonprofit work for some religious organizations. Phyllis Ann is a proud double graduate of St. John's University. She received a Bachelor of Arts degree in Government and Politics and English from St. John's College of Arts and Sciences in 1987, and she also graduated magna cum laude and was secretary of the Skull and Circle Honor Society. So like I said, you have good powerhouses here. I'm going to turn it over to Donna and Phyllis Ann so we can get going with our discussion. Donna's going to give you an overview of estate planning, and then we'll roll into how it all comes together. Phyllis Ann is going to talk about this big, beautiful bill. Okay, thank you.
All right. Hello, everybody. Good afternoon and Happy New Year. So what I wanted to tell you, what I'm going to talk about is about elder law, trust and estates. I also do trust and estates as well. So there's certain documents that you want to have in place. Those documents are your power of attorney. I mean, that's one of your major documents, healthcare proxy, and a will, possibly. Okay. So let me explain exactly what each of these documents are. So a power of attorney is a document that's going to give someone else the authority to do financial matters for you. Okay. So again, most of the time, what do I see? I see people that will appoint their spouse and then their children. Or sometimes if this spouse is starting to have cognitive decline, you may want to also add a child on right from the very beginning. So this way it'll make it easier going forward. So the power of attorney is a very, very important document because at the end of the day, what that's going to help us do, it helps for flexibility purposes. It will help us to be able to do any planning that in case you didn't want to go too far with your planning, but you wanted to get a basic plan in place. But then we have emergency situations, and those emergency situations, such as when people have a fall, land in rehab, or anything else that could happen, this power of attorney, if rightly done, and also, given to people that you totally trust, will be a document that's really going to help you. Okay. So it's so important, a power of attorney. Again, you should not do a power of attorney if you don't have somebody that you can trust, because that's the key basis for this document, because it is a powerful document. The other thing I would tell you about a power of attorney is that you don't want to give it, the person that you're going to pick, you don't have to actually give them the document until such time as they need to use it. So the power of attorney, so you need to sign it when you are mentally competent. If you're not mentally competent, no attorney should let you sign a document, obviously. So, you need to be mentally competent, but you don't have to give it to the person. They need to sign the document when they need to use it. Okay. You can appoint 2 people, I wouldn't go beyond 2 people for your primary person. You can have 2 people primary, 2 people secondary. Sometimes people have 3 kids. They want to appoint all 3 at the same time. It gets a little crazy then, but it can be done. So power of attorney gives us flexibility. Healthcare proxy is all about the health. If you are, you should always think about having a healthcare proxy, because that's a document that's going to say that if you cannot make medical decisions for yourself, then this is the person that you want making those decisions for you. Again, if you have a bunch of kids, really the doctor wants to only talk to one person. That's why we have a number 1, number 2, number 3. I can make as many people as you want be the healthcare proxy if that's what you choose. Like, say if you have, again, 3 kids, you want to put all 3 kids on there. Again, we just need a point person. So the healthcare proxy, you need to have a talk with your agent. You need to tell the agent what your wishes are regarding life-sustaining treatment. Okay, so that's really the key. Again, because the healthcare proxy is very broadly written. It's a document that says that my agent knows my wishes regarding life-sustaining treatment. If you want a document that is a little more specific, that document would really be a living will. So a living will is a document that says that if basically if I have an incurable disease, I'm terminally ill, so, I'm in a coma, do not resuscitate, do not intubate, do not. Okay. Again, these are documents. A lot of times my clients, I had a 90-year-old come in one time and she's like, no, I'm not ready for that one yet. So everybody's different. And so this is the other thing I would like to remind everyone. Everyone is different. Everyone has a different plan. Sometimes I have people come in and everybody's like, well, this one said this one said that. Susie Orman says this. So your plan is your plan. You have different facts than anybody else. So really, go straight to the source. That's what my suggestion would be. You don't want to just be taking someone else's advice. Well, my friend did this, my friend did that. That might not apply to you. So you really need to think about that. Okay. So then, the last document would be a will, right? Again, I'm going to, start talking about other stuff, as we go, I'm trying to build on things, right? So a will is a document where you're telling the world, basically, these are the people that I want this to be my beneficiaries, right? So remember, the will only controls things that pass through it. All right. So if you have beneficiaries on all of your assets, say if you have a lot of bank accounts, you have IRAs, you have 401ks, and all of those, you have life insurance, all of those documents and those accounts have beneficiaries. Those beneficiaries are who are going to take. Okay. Those documents are not going to be passing through your will. So, there's a will and a trust can sometimes be acting. First of all, in a will, we can create trusts. All right. trusts can often do the same things as wills can do. So, I'm going to go into that a little bit more. But let's talk about the different things that a will can do. We can do many things with a will. So again, first of all, we have to see what is passing through the will. And then the question is, what are we trying to accomplish with this will or with this trust, whatever we're going to be doing? So the things that it can do, it can actually do tax planning. We can do tax planning through the will, right? So, Phyllis is going to talk a little bit more about the tax stuff. So I'm just going to say very vague things, so if your estate is going, or if you're close to the line on whatever New York State is for their limits, then maybe we want to have a tax plan that says that we're going to have a credit shelter trust. So a credit shelter trust is a trust within a will, or it can be within a trust, where we're saying that if my estate is going over this limit, my spouse will have the opportunity to disclaim certain assets in my estate so that I can get tax. So we can use the tax credits for New York State in order to use all of our tax credits, okay? So a credit shelter trust can be done either individually or it can be done through a will. You can plan for minor children in a will or grandchildren in a will, right? Because very often we want to make sure that those children are taken care of. Again, we're not saying that everybody on this webinar is elderly. You might be someone that has minor children. So again, you might want your will to actually come into play because we want to make sure that the court is overseeing what is going on and making sure that any trust established in the will for the benefit of a minor is going to be monitored by the court. Again, maybe we want that, maybe we don't. We have to just think about, again, everybody's situation is different. Of course, we can do charitable giving in a trust, in a will, either one, okay? So we can actually say, okay, I want XYZ to go specifically, again, has to be passing through that will for it to actually go to the charity that you want it to go to. The thing about when we do have, I'll talk about, what happens with a will after someone dies as well. So again, we can do charitable giving. We can make sure beneficiaries get what you want them to get. We can also do planning for people who are disabled in our wills or our trusts, okay? So say if we have a beneficiary that has a disability, but we want to make sure that they can actually inherit. So we don't want them to inherit money outright. This can be a problem because if they inherit it outright, it could kick them off of their disability benefits, right? We don't want to lose anybody's benefits. So what we would want to do is then create maybe a supplemental needs trust within our will that we're going to say that I want this amount to go to this person or whatever I want to go to them, but it will go into a supplemental needs trust for the benefit of that person. The thing about this, things to remember is that we also need to appoint trustees within our will. So when we have the person in charge of the will is the executor, okay? You can have an executor, you can have a successor executor, you can have an alternate successor. So we try to work with whatever anybody wants. We can have co-executors. So we can have trustees also established in a will. And of course, if we are establishing wills, we want to make sure trustees are also named at least. So again, if we know that something's going for the benefit of a minor child and we know that the parent should really be the trustee for that trust, we can put that. Or we can put their sibling, the sibling of whoever passed away, because maybe it's their niece or nephew so that they're watching the money. So we have to just think about who the players are and who's best to have any of the jobs, right, that we're going to be assigning. So again, when we have a disabled person, who's the best person to be managing any assets for that disabled person? So these are things that, you need to start to think about if you're starting your estate plan. We've been getting, I'm telling you, my phone's been ringing off the hooks. Everybody must have made resolutions in January because it's been crazy around here. But, so the thing to remember is, whatever your plan is, you need to start to think about your plan so that at least when you go to see an attorney, that you actually have an idea of what you want happening, all right? And who the players are, if there are disabled people, if there are minor people, do we have tax issues that are possible? Because these are all things that can be, dealt with in your estate planning documents, okay? Another document sometimes so what happens with a will? Okay, so anything that's passing through the will, to actually effectuate the terms of the will, we need to go to probate. That means we file the will with the court. The will, is going to be filed. Usually you hire an attorney to do this because they have so many forms and so many requirements and so many rules that you need help. Okay. I mean, not to say that you couldn't try to do it on your own. That's definitely possible. But just to give you some thoughts about, you have to show who the heirs are. If we have a very large family, that's going to get a little crazy because there's a lot of people we have to get jurisdiction over. So there's sometimes when, say, there's certain situations where we might not want to go to court, okay? We might not want to have a will be the instrument that deals with our assets. That case, we might want to say, I need a trust, right? Again, there are certain situations that a trust is a better option than having a will. Again, certain situations, a will, we want it. Sometimes sometimes a trust is better. One of those situations that I find is when I have someone, this would be the usual scenario. The person's parents are both gone, okay? They had no siblings. They have no idea who their relatives are. They never had relatives that in the United States even. They could be in Italy from who knows, or they could be in Croatia. They could be anywhere around the world. They don't even have a clue. So in a situation like that, I got a problem if I have to go to court. Because the problem is that I'm going to have to get jurisdiction over these unknown heirs because that's what the court is going to require. All right. So in order to avoid that, I might want to have a trust. So again, if I have no children either, I have no husband, no children, no parents, I got no relatives. And unfortunately, there are people like that unfortunately. Some people might not like their relatives, but that's a whole nother. Oh, and yes, we can disinherit relatives as well in a will or in a trust or anywhere we need to. So that's another reason that you do, also you would have for belt and suspenders, probably if you're trying to disinherit somebody, you really need to put that in writing. All right. And you would want a will no matter what, just in case somebody tries to pull your trust into court. Okay. Because so with a trust, you're going to have different kinds of trust. There's many kinds of trust there, but a revocable trust is a trust where you're in charge, and it's only when you pass that's when the successor trustee will step into your shoes and take over your estate, almost with the exact same role as an executor. Okay, so they're going to be handling whatever's inside the trust or whatever's been pointed to that trust. So very often you might want to have so like I said, if this is the kind of scenario that we have, that might be one of the reasons you'll do a trust. Okay, there are other reasons that people do trust. Some people just hate going to court. They don't want to be dealing with the courthouse. So they're going to say, I'd rather do a trust. As far as trusts go, again, you can have supplemental needs trust to help disabled people. There can be many kinds of trusts. And I think Phyllis is going to talk a little bit more about the tax trusts, charitable giving trusts, different kinds of trusts that you can do. You can also do planning for, obviously, again, charitable giving through your wills and through your trust. And when it comes to doing, so people that are close to the limit can do what we call in the trade the Santa Clause, right? The Santa Clause is a provision that we can put in a trust, we can put it in a will, that says that if my estate is going over, maybe let's say the New York State limit, right? Then anything above that limit that would cause my estate to have to pay estate taxes, which nobody wants to pay estate taxes, then it would be going to a charity, and you can name that charity that you would want. Again, it's a great thing to do because at the end of the day, one of the fun things about my practice is I'm trying to make sure you don't have to pay estate taxes. Also, I mean, with the elder law, planning that we do is we're trying to make sure that if someone does get sick, that their estate is protected so it can get down to their grandkids and their children in case they need to get Medicaid, okay, which is a whole, another animal, all right? So, estate planning and Medicaid planning go hand in hand. So there's different things that we consider. Of course, different ages, different things are things that you want to also consider, right? We need to also consider if we have minor children, you want to be appointing guardians in your documents. And again, now we want to make sure that's something that is appearing definitely in your wills, more so than anything, because you want the court involved. You want to make sure there's somebody overseeing and protecting your children, right? And again, if you're not here, you and your spouse aren't here, then who's going to be, the guardians for these children. I know, creepy stuff. I don't get to talk about fun stuff. So that being said, trust can be very helpful to us. We have some, again, I think that, Phyllis Ann will talk more about the marital deduction and different thing about taxes to, hopefully sexy it up a little bit. Okay. So those are some things to consider. So also when you're giving the beneficiary, so again, the thing to remember is also that what people don't seem to understand is when we put beneficiaries on assets, that's great. There's many things that we can do beneficiaries. But if you just want to add somebody to the deed to your house, you're causing a problem. All right. The reason that you're causing a problem is that someone is not going to get the step up in the tax basis. Okay. So just adding people to your deeds means that they only get your tax basis in something. And that could cause problems later on when they try to sell. Again, I think, Phyllis Ann is going to really go into more detail about the step up in the tax basis for people to understand that a little bit more. And also, when it comes to IRAs and 401ks, the thing to also, remember is that, when it goes to the spouse, there's not, you can roll it. Back in 2020 and back in 2022, they changed the laws regarding IRAs and 401ks. All right. So what they said is that they can't just stretch like they used to. So they used to be able to stretch down, for generations almost, right? So now it's saying that if your child was to inherit your trust, your IRA or 401k rather, then what can happen with that is that, they have to take it within 10 years. So what I see a lot of when I'm looking at people's tax plans and estate plans and their Medicaid plans is that they have a lot of the money in their IRAs and 401ks and they never spend it because they think that, they want this to get down to, their heirs and things like that. But again, the heirs might still be young enough that they're at a higher tax bracket. So when they have to take the money, they're going to have to get taxed on it. Because when it comes to IRAs and 401ks, they're going to hit somebody with those taxes, right? Whenever you take the money out, they're going to take the money. They're going to take the taxes out. And that will depend on what your tax bracket is, okay? So you're going to see I gave you some handouts, about estate planning terms and things like that, power of attorney, just to explain them a little bit more. The one thing I am going to talk a little bit about now is how the type of trust that can help protect assets in case someone needs to go on Medicaid is an irrevocable trust. Okay. An irrevocable trust is a trust that you cannot be the trustee for. So usually most of the time, what do I see is I see that the children are the ones who are going to be the trustees, right? And we can have successor trustees and, whatever we need to do as far as appointing it. The idea of the irrevocable trust is that we're protecting the principle of whatever we're putting in there. We can make it so that if it's something that's income generating, that you still get the income. We make it a grantor trust so that anything that's within that trust will pass at the date of death. Okay. And that's why the children will get a step up in the tax basis. So an irrevocable trust can be very helpful to us for Medicaid planning. Because if you can't touch it, then Medicaid can't touch it, okay? And so the idea is very often, what do I see is people put their houses in the irrevocable trust. Because for Medicaid purposes, Medicaid always looks at two things. They look at the amount of assets that you have and also the amount of income that you have. In order to qualify right now for Medicaid as of January of 2026, the amount of money that you can have is $32,532 to your name, but that does not include IRAs and 401ks and Roths, any of your retirement accounts. So I've seen people with over $1 million in their retirement accounts still be able to qualify for Medicaid. You may have to put that into, payout, meaning you're requesting your required minimum distributions. Actually, on December 23rd, they just passed a new regulation for Medicaid where they're saying, oh, you might not have to put it into payout. But then I read through this new law, actually, and it's a little confusing because I think that you do have to put it in payout. Otherwise, the whole thing becomes exposed. So I think that they're just trying to confuse people so they can get more of your assets. Okay. And I think that So anyway, back to how this works. So an irrevocable trust, when it comes to to doing Medicaid planning, is we're trying to protect, even if it's only some of your assets, it doesn't have to be all of your assets, just so that we can get something down to your children. So there's many ways that we do that. One is the irrevocable trust. And very often what people are doing is they're just transferring their houses in, because for most of my clients, the house is one of the biggest assets that they have. And so, you still have to pay the rent, I mean, not the rent, all the expenses, you still have to, which is also helpful to us. Okay. The reason people do these things in advance is, first of all, they're making a plan, is because Medicaid has look back rules. Okay. Those look back rules. And I know next month you're going to have a much more detailed presentation regarding the Medicaid rules. So I'm just going to kind of like brush on some of them. But the reason that people do these things in advance is because there's look back periods. That's a penalty period. The penalty period is whenever you make a gift, Medicaid says, I'm not going to give you Medicaid now. All right. So there's look back periods on the transfer of assets. The transfer of assets for the nursing home is 5 years. The transfer of assets for home care is technically 2.5 years. Most people, the last place you want to go is the nursing home. So 2.5 years is really the thing that you should really be concerned about, because most people want to stay in their homes if they can, right? Again, every situation is different. So when it comes to the home care, you're allowed to keep some of your income. And actually, that's what we're waiting on right now. We don't have the 2026 numbers. The 2025 number is $1,800. That's how much of your income you can keep in order to stay home and get Medicaid at home and get aids in the house. So again, there's a lot more rules, but the idea here is that the trust is one way that we go ahead and protect that asset so that we can qualify for Medicaid in the future if that's something that might happen. In what Phyllis and I do, we try to do our best to help you get your assets in order, your affairs in order, help you to understand how the various tax things work, how the courts work, how Medicaid works, so that you can make your own plan and make a good plan for yourself, whatever that plan may be, looking at your situation, so that, and also that maybe you might want to consider leaving something to St. John's, and we would appreciate that. But again, you can leave them as a beneficiary on something that could be a tax benefit to your state. There's many things that can be done, and so I'm going to sum it up and just say, do something, okay? Do something, because I still have clients that would chase them down. Come on, you said you were going to do something. We want you to get your affairs in order. There's nothing worse than someone passing away and then people that you don't want to get your assets because it goes by the rules, the laws of the state of New York. And that might be your brother that you hate, or it could be your niece that, dissed you. It could be. So again, you really need to make a plan so that people that you don't want to get things don't get them. All right. So that's something to think about, right? All right. I'm going to turn this over to Phyllis and, take it away, Phyllis.
Okay. Good afternoon, everyone. And I just want to reiterate a few things that Donna was pointing out. When you meet with an estate planning attorney, it's important that you share with them information about you and information about your assets. We can only help you based upon the information that you provide to us. And the reason why it's important for you to share information about your assets in particular is so that we can guide you on things such as estate taxes, which I'm going to talk about in a few moments. It's important for us to know the type of assets that you own, roughly the value of the assets that you own, and how you own those assets, whether they are owned individually, whether there's a beneficiary designation in place for those assets, or whether there's a joint owner for those assets. All of those things will impact how your estate plan is prepared and whether or not it might have tax implications. So any estate plan should entail at least a review of estate taxes, even if the estate taxes don't apply to you. So my job here today is to enlighten you a little bit about the current estate tax rules and some gift tax rules under the One Big Beautiful Bill Act and the current laws in New York State. So I'm going to talk first about the federal estate tax changes under the One Big Beautiful Bill Act. As many of you may already be aware, you have available as a U.S. citizen a lifetime exclusion for gift and estate taxes, which the One Big Beautiful Bill made increased and made permanent at $15 million per U.S. citizen. Okay, now that's what's known as a unified exclusion that's available for you to use during your lifetime in making taxable gifts. And whatever you don't use during your lifetime is available to exclude a certain amount of your assets from federal estate tax upon your death. Now, the One Big Beautiful Bill increased the exemption over the Tax Cuts and Jobs Act exemption of 2017. Just to take you back quickly through to a little bit about the tax laws. Prior to 2017, the federal estate tax exemption was $5 million per individual, indexed for inflation back to 2012. The Tax Cuts and Jobs Act that was enacted in 2017 increased that exemption to $11 million per U.S. citizen. But the Tax Cuts and Jobs Act was set to expire at the end of December in 2025. The One Big Beautiful Bill Act made permanent certain changes that were initially introduced under the Tax Cuts and Jobs Act. And one change was a permanent increase in the amount of this exclusion. So every individual now has a $15 million exclusion for federal estate tax. There's no expiration date for that higher limit. And the maximum estate tax rate under the One Big Beautiful Bill was maintained at 40%, which was what was introduced under the Tax Cuts and Jobs Act. A few other pointers that the One Big Beautiful Bill did not touch or left intact were basis step-up issues. Donna made reference to them earlier. So let me just explain to you quickly, if you're not familiar with basis step-up, the significance of it. If I were to go out and buy a share of Con Edison stock at $10 per share, and I hold on to that stock and until I die, and it's worth $100 per share at the time of my death, my beneficiaries of my estate will inherit that stock at $100 per share as their basis in that stock. Then my executor then turns around, or my beneficiary turns around and sells that stock. The capital gains will be computed on the difference between the value of that stock on my date of death and what it is sold for. That is what is known as basis step-up. The original $10 basis that I bought the stock for no longer matters as long as I continue to own that stock at the time of my death. The heirs of my estate will get the benefit of inheriting it at the value of what it is worth on my date of death. And that helps them minimize the amount of capital gains tax that will be paid. Basis step-up then has been maintained under the One Big Beautiful Bill Act. Now, another thing that's been maintained under the One Big Beautiful Bill Act is an unlimited marital deduction. What that means is that if I have a spouse and my spouse passes away, I can inherit an unlimited amount of assets from my spouse and not have to pay estate tax on it because all of the assets that I inherited are entitled to a 100% deduction. That continues to be maintained. Now, with the higher federal exemption, you may say, well, my estate's never going to be subject to estate tax. And the reality is that maybe only 1 or 2% of all the estates in the United States are ever subject to federal estate tax. However, if you are a resident of certain states, including New York, you not only have to consider and review estate tax rules with respect to the federal government, but you also have to determine whether or not the state that you live in also continues to have state estate tax. And unfortunately, New York is one of 18 states that still has state estate tax. I like to say that New York likes to tax us to death. Unfortunately, it's true in a lot of respects. And New York State, the New York State estate tax rate has the highest rate that they can charge is 16%. And if your estate is subject to both federal and New York State estate tax, that could be a significant amount of your assets that are allocated to pay estate tax rather than going to the beneficiaries that you select. So that's all the more reason why it's important for you to develop an estate plan that accomplishes the objectives that you want to accomplish. There are several problems with the New York State estate tax exclusion amount. The primary problem is that there's a lower exclusion in New York for estate tax than there is on the federal forefront. Okay. New York State's current exclusion for state estate tax is $7,350,000 per New York State resident. Now, the history behind the New York State estate tax, just to give you a quick background, is as follows. Technically, the legislation under the New York State Tax Code says that the New York State estate tax exclusion should match the federal exclusion at this point in time. However, that legislation predated the Tax Cuts and Jobs Act in 2017. When the Tax Cuts and Jobs Act increased the federal exclusion from $5 million to $11 million, the New York State legislature made a conscious decision not to follow the Tax Cuts and Jobs Act increase in the exclusion. Had they chosen to follow it, which would be consistent with the way that the law is written in New York, the exemption for New York State would match the federal exemption today. It does not. New York instead chose to continue to follow the $5 million exclusion index for inflation back to 2012. Now, there is inflation indexing built into the New York State exclusion amount so that the amount does increase slightly each year. But the New York State legislature has just made a conscious decision now based on the passage of the One Big Beautiful Bill Act that they are continuing not to follow the higher federal exclusion. Unless something changes in the springtime when they review their budget, right now, as of January 1st, New York continues to maintain a lower exclusion amount tied back to the original $5 million exclusion under the old federal law, indexed for inflation to today. So that's how you get to the $7,350,000. Now, there are a couple of other problems with the New York State estate tax exclusion. There is a fiscal cliff built into the New York State estate tax law, and that cliff says that if the value of your assets exceeds that exclusion of $7,350,000 by more than 5%, then your estate loses the entire exclusion. It falls off the cliff, essentially. Now, 5% more than $7,350,000 means your estate is valued at $7,717,500 or more. And you may say, well, that's not, my estate will never reach that level. But in reality, and what I've seen in my practice is it can very easily reach that limit or exceed it because we live in a state where real estate prices, the cost of living, and incomes are higher than any other place in the United States. And when you have a married couple, and that married couple owns a house, each individual has worked sometime, and they may have each of the partner in the couple may have retirement accounts, may have life insurance, plus other investments and bank accounts that they own jointly, in addition to personal property, artwork, jewelry, cars, things like that. A married couple can easily exceed that exemption amount when you combine their assets. And that's important, especially when you're conducting estate planning, because there is a way to minimize New York State estate tax through proper planning. Donna made reference to it before. There is a type of trust that can be built into your last will and testament or your trust, known as a disclaimer exclusion trust, which attempts to preserve the New York State estate tax exclusion for each spouse to pass the maximum to their children. So the use of this mechanism in your estate plan can effectively shelter twice the New York State estate tax exemption. It can shelter both spouses' New York State exemption of $7,350,000, passing to their kids or their secondary beneficiaries more than $14 million free and clear of New York State estate tax. Now, one of the other problems with the New York State estate tax law is not only that it's a lower exemption and that there's this fiscal cliff if you exceed it by more than 5%, but under New York State estate tax law, there's nothing that allows for automatic portability of a spouse's unused exclusion amount unless you have included provisions and plan for the protection of that credit in your estate plan. So I'm going to take you back just for a minute to explain a little bit about this. So portability is a concept that is currently available under federal estate tax law. And portability says that if a spouse dies and they pass everything through their surviving spouse, their lifetime $15 million exclusion may not be needed because their surviving spouse is eligible to inherit all their assets free and clear of estate tax, because there's an unlimited marital deduction for whatever the spouse inherits. Now, if that were the case and you didn't have an estate plan, the first spouse would die, the second spouse would inherit everything. The second spouse still would not have to pay estate tax, but the second spouse's estate now is that much larger because they own their own assets plus whatever assets they inherited from their spouse. And when that second spouse dies, they only have their own exemption to exclude the assets that they own from estate tax at the time of their death. The concept of portability allows for the first spouse's unused estate tax exclusion to be ported or transferred to the surviving spouse. So if the first spouse had a $15 million exclusion available to them and they died and they passed everything, they directed everything be paid to their surviving spouse, that $15 million exclusion from the first spouse can also be transferred to the surviving spouse to double that spouse's estate tax exclusion to $30 million. And the simple way that that is accomplished is all the surviving spouse has to do is they have to file an estate tax return for the deceased spouse requesting that the unused exclusion be ported or transferred to the surviving spouse. New York State, unfortunately, our estate tax laws do not allow for that automatic transfer of the unused exemption to the surviving spouse. So the only way that a surviving spouse in New York can minimize estate tax for their children, or the only way that a married couple can minimize estate tax for their children, is to have a properly drafted estate plan that allows for the protection or the preservation and the passing of that unused exemption to a trust, which will operate during the lifetime of the surviving spouse. I don't want to get into too many technicalities regarding that trust because that's something you can discuss with an estate planning attorney, but I just want you to I want to emphasize the importance of why estate planning can be so significant, particularly when you're in a state where estate tax still exists. So if you have that married couple and they own jointly or individually together, their combined assets can easily exceed that $7,350,000. There is a way to minimize or eliminate completely any New York State estate tax on that differential. Okay. Now, gift planning can help and be very beneficial in an estate plan to help minimize estate taxes. The federal estate tax exclusion, I think I referenced it in the beginning, is what's known as a unified exclusion. It is tied to the federal gift tax exclusion. So every U.S. citizen has the ability to gift up to $15 million during their lifetime. If they gift a significant amount of their assets, they may be required to file a gift tax return. If the total value of what they've gifted during their lifetime doesn't exceed $15 million, they may never have to pay gift tax. Okay, but you begin to deplete this lifetime exclusion by making significant gifts during your lifetime. There are certain types of gifts that you can make under the federal tax code which do not affect your lifetime exclusion. And some of these you're probably already familiar with. The first one is what's known as the annual exclusion gift. Years ago, you were told that you could give away up to $10,000 per individual each year. Okay, that's what's known as the annual exclusion gift. The good news is the amount of that gift today is $19,000 per donee. And that is true under the One Big Beautiful Bill Act that continue to maintain and allow these annual exclusion gifts at $19,000 as of this year. The One Big Beautiful Bill does also provide for indexing inflation on this $19,000. So this amount will increase over time in subsequent years. So I could gift to any individual this tax year up to $19,000. And I can gift that $19,000 to as many individuals as I want in this one tax year. that could be a significant benefit to an individual whose estate is quite sizable and they're worried about estate tax. I've had estates where the individual used the annual exclusion gifts to minimize their estate over time. They implemented a gifting plan. They established it, and every year they would make a gift of $19,000 to each of their kids, each of their grandkids, each of their sons-in-law or daughters-in-law, even to friends and other individuals. So the annual exclusion gift does not require you to file a gift tax return. It does not require you to pay any gift taxes. Second type of gift that's allowed under the federal tax code, which is a non-taxable gift, are gifts to pay the medical and educational expenses of any individual in any amount, provided the payment is made directly to the provider of service. So if you know someone that is going to St. John's University, whether it be a family member or a friend, and you want to help them, you can pay that individual's tuition directly to St. John's University in any amount. And the payment to the provider of service for medical and educational expenses directly to the provider will not require you to file a gift tax return or require you to have to pay any gift tax, and it will not deplete your lifetime federal gift exclusion. Okay. Now, in New York State, thankfully, we did away with gift tax in New York State back in the year 2000, surprisingly. So you don't have to worry about gift tax filings or gift tax payments in New York State. So that's the reason why gifts can be very important in your estate plan to help minimize overall taxes. Charitable giving under the One Big Beautiful Bill has changed a little bit. There are many benefits still available under the One Big Beautiful Bill. One of the prime benefits is that usually you would have to itemize deductions for charitable contributions. Now, effective as of this year going forward, every taxpayer gets an automatic deduction of $1,000 for charitable donations, okay, regardless of whether they itemize or they claim the standard deduction. So that's a benefit that we didn't have previously. One of the other changes enacted under the One Big Beautiful Bill imposes a 0.5 percentage floor on the amount of charitable contributions that an individual makes if that individual itemizes their deductions on their tax returns. Now, I'll give you a simple example of how this works. So if I have an adjusted gross income of $100,000, the 0.5% of $100,000 would be the equivalent of $500. That is the minimum floor I have to exceed to make a donation in order to claim the excess above the $500,000 as a charitable deduction. Okay. There are some materials that Luke is going to post to the webinar page after the webinar is complete that explains this more fully. But the point of it is that an individual who's itemizing charitable deductions has to satisfy and exceed that 0.5% floor of their adjusted gross income before the amount over that amount can be claimed as a charitable deduction. One of the other changes under the One Big Beautiful Bill is that the maximum benefit for a charitable deduction is limited to 35% regardless of the tax bracket you are in. If you're a high income earner and you're in a 37% income tax bracket and you make a lot of significant charitable donations, your deduction for those charitable donations will be limited to 35%. Two other quick changes. I know we're coming to running out of time here. So there is a maximum deduction that is allowed under the One Big Beautiful Bill for cash donations to a public charity. But this is limited to 60% of the donor's adjusted gross income. That might seem like a limitation to you, but this is actually an increase under the prior law, which only allowed 50% of a donation, significant cash donation, to be deducted. So that's a benefit that's been provided under the One Big Beautiful Bill Act. And one last thing is that the One Big Beautiful Bill proposes that there will soon be a $1,700 tax credit for donations to scholarships for elementary and high school scholarships and education costs. That's proposed for 2027 or later. Okay, that's a very quick rundown of gift and estate tax. And I hope it leaves you with the impression that it's important to review these things in the context of creating your entire estate plan. If you're working with a competent professional, they are most likely going to address these things with you. The one caveat that I can recommend to you is do not be afraid to share information with your professionals. It's very important for them to create an effective estate plan, to know information about you, information about your family tree, information about your assets. Everything that you tell them is going to be held in confidence. It's also very important that you have a coordinated team preparing this estate plan. So it's not unusual for your estate planning attorney to communicate with your accountant and your financial advisor to coordinate the different facets of the plan. Okay, I hope that the information I've provided is of help to you, and I'm happy to take any questions either in the time remaining or afterwards.
Yes, thank you both. We do have time. We have a little time. So if anyone has any questions, you can put it in the chat or you can just unmute yourself and ask Donna and Phyllis Ann.
Steve Conroy, what is the deadline for filing a trust return?
A trust can file a tax return either, an estate can file a return either on a fiscal year or a calendar year. A trust files on a calendar year.
Okay, thank you.
You're welcome.
Luke also dropped that link that Phyllis Ann you were referring to. He dropped that in the chat, but we will also include that in the follow-up email.
Yeah, I just want to add one thing.
Sure.
I just went through, my wife's the executive for her cousin's trust and estate, and it takes 3 months to get letters of testamentary out of Nassau County when you can get them in 3 weeks in Queens. They're so antiquated. Their document management system is awful. They got stuff from the 70s. You can't. There's no fill-in PDFs or anything. It's just absolutely horrible. It's a shame. And all the taxes we pay in Nassau County and what you get out of the surrogate court is absolutely garbage.
It can even sometimes take longer for even a simple proceeding.
Yeah, 3 months in Nassau is good, believe it or not, you know.
Well, we're pushing it 4 months now.
Well, the good thing in Nassau, we have a new surrogate. He is learning the ropes still, but he's just taken office. Some of the problems related to the past administration, we hope that that's going to turn around soon.
I'm surprised I'm hearing Queens was quicker.
Well, Queens isn't always quicker. It's gotten much better. Brooklyn's a horror story.
Brooklyn is very bad.
New York County is actually very good.
New York County's been pretty good lately.
Yep.
Yeah,
Really?
But Queens has definitely picked up. Definitely.
And have they recovered? Is this still, we're feeling the effects of the pandemic?
It's still, in some places, it's still that. Yeah.
That's Brooklyn's excuse.
Yeah, I know. That's,
well, and the Bronx isn't so great either. I'll tell you that. It's those bees, Nazis, you know.
Yeah.
I know. I'm like, how long are we going to use this excuse for?
I know.
Yeah.
10 years later, it's the pandemic. Anybody else have any questions? Come on, free advice here. Take advantage of it.
I guess not. Everybody knows everything.
Well, I hope you did walk away, and I think both Donna and Phyllis Ann stress. I know sometimes, and lately they're even coming to me, encouraging people to do their wills online. I certainly do not promote that. I don't care how simple an estate you have. I think when it comes to estate planning, all the years of listening to our experts speak, you never know what your circumstances are, and you might think it's very vanilla, and it may not be. So I think it's really important to go to an estate attorney and let them help you put together a plan, simple, sophisticated, whatever it may be, to protect yourselves. Is 5 years still? Because I tell people 5 years, but you're the expert. To revisit a will, 5
I
years,
tell my
what you
clients
say?
at least every 5 years to take it out.
Really?
You know,
Mhm.
Donna can confirm this too. That, you know, the laws concerning estate planning don't change that rapidly, but people's personal circumstances change.
Yeah.
Right.
So if something happens in your family and you were going to leave all your money to, Judy, and she passes away, well, you better get another plan. You know what I mean?
Right,
So you really
right.
have to keep, I guess it's life events are the things that kind of trigger someone looking at whatever their documents are to make sure that everything's still the way you want
Right.
it.
Right. And Susan, the thing about the online wills, what people don't realize is every state has their own rules and their own definitions and regulations regarding estate planning.
Right.
That document you're finding online, it may say that it's created for New York residents, but do you really know that? And you're only going to know
Right.
by meeting with competent professionals.
Well, you know
And the
what? One
other,
thing I wanted
yeah,
to
sorry,
remind
go
people,
Donna.
if you have
Mhm.
properties in different states,
Mhm.
a trust is a very good idea. Okay, because if you have a property in different states, then that might cause us to go to court in different states. It's called ancillary probate. So in order to avoid that, a trust can be very helpful. We can put all of your properties from Pennsylvania, from Florida, from South Carolina, wherever it is, into the one trust, and then that helps keep us out of court in all of those states.
Another thing I want to ask, and I like to stress because we're now in this technological world, we have passwords. People are doing banking online, computers. Someone passes on, like Steve was just saying, his wife is taking care of a cousin's estate. They may have had everything protected with passwords and everything. How do you handle that?
We're
I found
incorporating
them.
in our wills and our powers of attorney provisions that allow the agents and the executor access to things like passwords and digital
Right.
documents and information. And we can encourage our clients when we meet with them to share it with the individual that they're picking it to serve as their executor or their agent.
That's what
Yeah,
I was going to
Susan,
ask you. So if someone comes to you and now you say, you have to share the passwords, but maybe some people during their lifetime still feel a little skittish. Is
So,
there like
yeah,
do you say to set up like a separate password and
well,
put everything separately in one area so then they don't have access to look at all your information
right.
online?
You,
Yeah.
you, right, or you can, or I'll tell my clients, particularly, for example, with the power of attorney, a spouse may appoint their spouse as the primary agent and the kids as the secondary agents. And they want the spouse to handle everything as long as the spouse is able to. So I always tell my clients, okay, that's fine. Then I have them sign, and Donna probably does this too, multiple duplicate originals, so that they have more than one in case something happens to that one. But I tell them, okay, then hold on to these. And if the time comes when your spouse passes away before you or is unable to act on your behalf, you tell your kids where you have the information stored, whether it be, if you're keeping it at home, I always tell them, do not put it in a safe deposit box, put it in a safe at home or a fireproof box at home. And put your passwords in there too. Let them know where they can find that if it ever comes to pass. But they're hopefully only picking agents that they trust implicitly.
Right. No, that's
Yeah,
good.
that
That's
is
good.
the hope.
Right.
That is the hope,
And in
definitely.
terms of charitable giving, obviously, this is what I see all the time. I know sometimes people say, well, Susan, you talk about the McAllen Society and how to become a member, but what do I do? Like, what's the first step? And I would say the first step is if you are having conversations with your estate attorney, obviously, like, Phyllis Ann and Donna was stressing, like, please share all this information. If you're thinking about making a gift or maybe a significant planned gift to an organization, share that with them because they can help you, guide you. And obviously, we have a relationship. So, they would contact me. They wouldn't contact me if they didn't want you to share that information. But if you were fine, then both of us can kind of work together, which it does work really well because I kind of know, obviously I know the side of how to process this gift on the charitable side and help the attorney with that information. And obviously the attorney can guide that client into, how to maybe set up an endowed fund for a scholarship. and how to word it. Because I know for myself, I usually advise, and Donna and Phyllis, and you tell me differently. I usually advise someone just to say they're giving to St. John's University, and maybe it's certainly, they want to give to Peter J. Tobin College of Business or St. John's College. I don't like to really go into more detail because I feel like if anything changes, they have to keep going back to the attorney and then keep having to edit that document. Where if you're establishing an endowed fund, we have an agreement that we draw up between you and the university. So if you have to make any changes, you can easily make those changes on the university side rather than to have go every time to the attorneys. But the attorneys might say differently. I don't know. What's your thoughts on that? Of how detailed should they be on their charitable giving in the will or in the trust? Is St. John's enough?
I think with St. John's, because they have this special procedure for the endowed funds where you can say, I want a scholarship in, my name or my husband's name or something like that. And they're very, very, and they stick to it. You know what I'm saying? So I don't know how any other universities actually handle that exactly, but I've seen how St. John's does. And I can say that that's definitely an excellent procedure. And whereas, you can, I think, be a little more broadly, you can maybe refer to the endowment document, or saying that, in some way that would be applicable, that would make it clear that that's what you want done. So but still have the flexibility.
Yeah, and it also depends on the type of gift that you're making. Like, for example, you can make a specific bequest of a certain dollar amount or a fixed percentage under your will or your trust to St. John's University. For that, you should specify, okay, do you want St. John's University to use it for their general purposes or a particular purpose? But if a person is establishing or wants to establish an endowment after they've died with assets from their estate, usually what I've done is I'll have them negotiate the agreement with St. John's University first, and we refer to that agreement in the will or the trust, and we say, if at the time of if it's a scholarship to be established after the person has died, then the will or the trust says, I've entered into an agreement dated such and such with St. John's University to establish a scholarship in memory of A, B, and C. And then, and the purpose of that scholarship is to benefit students of the School of Education. That then memorializes the agreement that St. John's has with that individual, tells the executor, okay, this agreement does exist. So it puts them on notice that they need to then work with St. John's to carry out the fruition of that. But it doesn't necessarily require them to name the scholarship at that point. Right.
No, thank you for specifying that. And especially if it is a general gift where you're leaving some money or a percentage in your will, it is good to say general purposes, or if you wanted to go to the school, because the school then needs that direction. I know we have a lot of retired professors that give back to the school and leave a legacy, but unfortunately we never get to have the conversation. And then I notice sometimes that they'll leave it to St. John's University, and here they were, say, a professor for 50 years in chemistry, and I'm like, wow, you were there so long in that department, and it's a shame you didn't specify chemistry. Because if you say St. John's, then it's going to go directly just, for general purposes for the university, which is, I'm not saying a bad thing, but, you just see he was part of that department for so long. It wouldn't be nice to see maybe 50% and 50% for general purposes or something like that. So I agree again that, you do want to talk to your advisors, but it is great to call me and to share with me what you'd like to do, because sometimes we can really develop something really special and meaningful to create this legacy that you want to leave at St. John's. So I'd like to leave it with that as well. So dialogue and communications is good, and we're here to really to help and really help you in the process, because as you can see with everything mentioned today on this call, it is overwhelming, and it is complicated and confusing, and laws do change. I know over 22 years my head spins when I see all the developments that have taken place over the years to try to keep up with it, even for myself in my world. So it's not easy, but thankfully we have this. And I hope you see that St. John's is a resource to you, and we here to help you and to educate you about this so that you can put together the best plan for yourself and for your family and heirs. So thank you for coming on, and you should pat yourself on the back for taking the time to do this for yourself and to help yourself. And we hope that these Power Hour lunches are helpful for you, and we will continue to offer more. In fact, the next one is February 11th that we have with Tanya Hobson Williams, who's an excellent elder care law, and she'll a lawyer, and she'll be talking about Medicaid and Medicare. And I have actually a lifelong friend who's an insurance broker, and she's wonderful. She treats her clients like they're her family and really helps them navigate this another difficult process and trying to figure out the best in terms of insurance that will help and protect you. So I hope you'll join us for that as well. And all our power lunches start at noon. So thank you again. Good to see everyone on the call. Happy New Year. Can we still say that, or is it too late? I don't know.
Yeah.
But
Happy New
thanks
Year.
to Donna and Phyllis Ann again
All right.
for sharing your time. We appreciate it. All
Well,
right, take
have
care,
a good
everyone.
day,
If you-
everybody.
If you